Three forces are converging right now. The Clarity Act is moving through Congress, potentially legalizing stablecoins for banks within months. The U.S. Treasury is preparing to issue $12 trillion in short-term debt over the next 6 months. And geopolitical conflict just escalated in a way that's sending capital into defensive positions globally. Most people see these as separate headlines. Crypto regulation, treasury markets, war developments. But they're not separate. They're interconnected systems that shape how capital flows, where risk lives, and what happens to markets when they collide. Here's what almost nobody is explaining. These three forces don't just coexist. They interact. Regulation changes what's legal. Liquidity changes what's possible. Geopolitics changes what's preferable. And when all three move at once, markets don't behave the way headlines predict. They behave the way systems respond under stress. If you want to understand how markets actually work when multiple forces converge simultaneously, subscribe. Because what comes next is going to reframe how you think about what's happening right now. Let's break down each force, then examine what happens when they intersect. Let's start with the Clarity Act because this is the regulatory shift everyone's watching. The legislation aims to provide a clear framework for digital assets in the United States. Specifically, it addresses stablecoins, giving banks explicit permission to issue, hold, and transact with them under federal oversight. Why does that matter? Because right now, the regulatory status of stablecoins is ambiguous. Some agencies treat them as securities. Others treat them as commodities. Banks don't want to touch something that might trigger enforcement action 3 years from now. That ambiguity has kept institutional capital on the sidelines. The Clarity Act would remove that ambiguity. It would establish licensing requirements, reserve standards, and operational guidelines. Banks could integrate stablecoins into their systems without fearing retroactive prosecution. That opens the door for massive institutional participation. Estimates suggest the bill has an 80 to 90% chance of passing, but there are sticking points. One major debate centers on yield. Should stablecoin issuers be allowed to pay interest to holders? Banks argue that if they can't offer yield, they're at a competitive disadvantage compared to non-bank stablecoin issuers. Non-bank issuers argue that forcing them to become chartered banks creates barriers to entry. This isn't just a technical dispute. It's a structural question about who controls the future of digital payments. If banks dominate, the system looks centralized and heavily regulated. If tech companies dominate, the system looks decentralized but potentially unstable. The compromise being negotiated will determine which path wins. Standard Chartered noted that the debate has shifted from whether banks will participate to how they'll participate. That's a significant change in tone. It signals that institutional adoption is no longer hypothetical. It's imminent, pending final regulatory clarity. Timeline matters here. The White House set a deadline of March 1st for finalizing key provisions. If that deadline is met, banks could begin integrating stablecoins into their infrastructure by mid-year. If it's delayed, uncertainty persists, and capital stays cautious. The takeaway? Regulation isn't just legal paperwork. It's the infrastructure that determines whether trillions of institutional dollars can flow into digital assets or remain locked out. And right now, that infrastructure is being built. Now let's add the second force, Treasury issuance. Over the next 6 to 7 months, the U.S. government plans to issue $12.2 trillion in short-term Treasury securities. That's not a typo. $12 trillion. For context, the entire quantitative easing program during COVID was $4.8 trillion over 2 years. This is more than double that, compressed into half a year. Why so much issuance? Because the government is rolling over existing debt and financing ongoing deficits. Short-term bills mature quickly, so they need constant refinancing. As interest rates have risen, the cost of servicing that debt has increased, which creates a feedback loop. More borrowing to cover interest payments on previous borrowing. But here's where it gets interesting for markets. Where does the money come from to buy $12 trillion in treasuries? There are two main sources: money market funds and existing asset holders. Money market funds currently hold trillions in assets. When new treasury bills are issued, those funds buy them. That's relatively neutral for risk assets because the money was already sitting in cash equivalents. But if money market fund balances are stable or declining, the Treasury has to attract buyers from elsewhere. That means investors selling stocks, bonds, or other risk assets to buy treasuries. When that happens, liquidity drains from risk assets and flows into safe assets. That's contractionary. It tightens financial conditions. Now layer in the Federal Reserve's position. The Fed has been shrinking its balance sheet, letting treasuries mature without reinvesting. That's quantitative tightening. It removes liquidity from the system. If the Treasury is issuing massive amounts while the Fed is withdrawing support, you get a liquidity squeeze. This matters for crypto because digital assets are risk assets. When liquidity tightens, risk assets sell off. When liquidity expands, they rally. The 12 trillion question isn't just about treasuries. It's about whether that issuance absorbs liquidity from other markets or whether new money enters the system to buy them. If money market balances stay high, the issuance is absorbed smoothly. If they fall, something else has to be sold. And historically, crypto sells first because it's the most liquid, most volatile, and least institutionally embedded asset class. Third force, geopolitical conflict. Recent developments have escalated tensions in multiple regions. Markets react to geopolitical risk in predictable ways. Capital flows out of risk assets and into defensive positions. U.S. Treasuries, gold, the dollar. These are safe havens when uncertainty spikes. This is not a political commentary. It's a mechanical observation. When geopolitical risk rises, investors reduce exposure to assets that could experience sharp drawdowns. Crypto is high on that list. Equities come next. Corporate bonds follow. The flight to safety is a structural response, not an emotional one. But here's the nuance. Markets often overreact to geopolitical events in the short term and underreact in the long term. The immediate response is fear-driven. Sell everything risky. Buy everything safe. But over weeks and months, markets reassess. If the conflict doesn't escalate into full systemic disruption, capital flows back into risk assets. If it does escalate, the defensive positioning persists. The challenge for anyone trying to understand market behavior right now is separating the noise from the signal. Geopolitical headlines create volatility, but that volatility doesn't necessarily indicate a new trend. It indicates uncertainty, and uncertainty resolves. The question is whether it resolves through de-escalation or through adaptation to a new baseline risk level. For crypto specifically, geopolitical risk creates selling pressure in the short term but doesn't change the long-term adoption trajectory. Institutions building stablecoin infrastructure don't stop because of a conflict. Regulatory frameworks don't disappear. Technology development continues. What changes is the timing and the sentiment. And those are temporary factors unless the conflict fundamentally alters global financial architecture. Now let's examine what happens when these three forces intersect, because this is where understanding systems becomes more valuable than reacting to headlines. Force 1 is regulatory clarity. If the Clarity Act passes, it legitimizes stablecoins and invites institutional participation. That strengthens the structural framework over time because it expands the addressable market. More participants, more capital, more use cases. Force 2 is Treasury issuance. 12 trillion in supply creates demand for liquidity. If that demand drains capital from risk assets, it creates short-term pressure. If it's absorbed by existing cash balances, it has neutral impact. The outcome depends on where the money comes from. Force 3 is geopolitical risk. Conflict drives capital into safety. That creates pressure on risk assets in the short term. But it also increases demand for decentralized alternatives to traditional finance, which can support crypto adoption structurally over time. So how do these interact? If regulatory clarity passes while liquidity is tight and geopolitical risk is high, you get a mixed signal. Strengthen structure. Tighten conditions. The market might sell off despite positive regulatory news because near-term liquidity and risk sentiment override long-term fundamentals. Alternatively, if liquidity improves and geopolitical risk fades while regulation passes, you get alignment. Strengthen structure. Improved conditions. Positive sentiment. That's when markets move decisively. The mistake most people make is treating each force in isolation. They see the Clarity Act and assume crypto rallies. They see Treasury issuance and assume crypto sells. They see geopolitical conflict and assume everything crashes. But markets don't respond to single inputs. They respond to the interaction of multiple inputs across different time frames. understanding that interaction requires thinking in systems, not stories. Stories are linear. Regulation passes, price goes up. Systems are dynamic. Regulation passes, but liquidity is tight, so price consolidates. Then liquidity improves, and price catches up to the regulatory shift. Let's dig deeper into liquidity specifically, because this is the force most people misunderstand. Liquidity isn't just money in the system. It's the availability of capital to flow into assets without causing disruptive price moves. When liquidity is high, markets absorb buying and selling smoothly. When liquidity is low, small flows cause large price swings. The $12 trillion in Treasury issuance tests liquidity. If buyers exist without sellers of other assets, liquidity is fine. If buyers only exist when other assets are sold, liquidity tightens. The Federal Reserve's quantitative tightening compounds this because the Fed was the largest buyer of treasuries for years. Without Fed demand, private sector demand has to fill the gap. Here's where stablecoins enter the picture. If the Clarity Act passes and banks issue stablecoins at scale, those stablecoins represent new liquidity. They're dollar-denominated. They settle instantly. They're blockchain native. That makes them useful for payments, settlements, and collateral. And if they're useful, demand for them grows. Growing stablecoin demand means capital flowing into stablecoin reserves. Those reserves are often held in short-term treasuries or cash equivalents. So stablecoin growth could actually help absorb treasury issuance without draining liquidity from risk assets. It creates a new source of demand for safe assets that doesn't compete with risk assets directly. This is a positive feedback loop. More stablecoins mean more treasury demand. More treasury demand means smoother issuance. Smoother issuance means less liquidity pressure on risk assets. Less pressure means improved conditions for crypto. And improved conditions for crypto mean more use cases for stablecoins. The loop reinforces itself. But that only works if stablecoins are legal and banks can issue them. Without the Clarity Act, this loop doesn't start. Capital stays in traditional structures. Treasury issuance competes with risk assets for liquidity. And crypto faces headwinds. This is why regulatory clarity and treasury issuance aren't separate stories. They're connected through liquidity dynamics. One creates supply. The other could create demand. Whether they balance or clash determines market conditions. Now let's address the geopolitical component more directly. Conflict doesn't just create fear. It creates structural shifts in how capital is allocated globally. When geopolitical risk rises, countries and institutions reassess their exposure to systems controlled by potential adversaries. That includes financial systems. This has implications for decentralized finance. If traditional financial infrastructure is perceived as vulnerable to geopolitical disruption, alternatives become more attractive. Blockchain-based systems don't rely on single points of control. They don't freeze accounts based on political decisions. They operate according to code, not policy. That's both a strength and a weakness. The strength is resilience. The weakness is lack of recourse. If you lose access to traditional finance, you can appeal to authorities. If you lose access to a decentralized system because you lost your private key, there's no appeal. Different risks. Different trade-offs. But in a world where geopolitical conflict threatens financial access, those trade-offs shift. The risk of political exclusion from traditional systems rises. The relative attractiveness of decentralized alternatives rises with it. That doesn't mean overnight adoption. It means gradual structural shifts over years. The interesting dynamic is that geopolitical conflict creates short-term fear, but long-term demand for alternatives. In the immediate aftermath of escalation, capital flees risk. But over time, as the conflict persists or becomes normalized, capital flows into systems that reduce exposure to geopolitical risk. Decentralized finance qualifies. This is why geopolitical risk creates pressure on crypto in the short term while potentially supporting long-term adoption. Short-term pressure because it's a risk asset. Long-term structural support because it's a hedge against centralized system vulnerability. The timing of those effects determines whether markets move up or down at any given moment. So where does that leave us practically? How should you think about markets when three major forces are converging simultaneously? First, recognize that short-term and long-term dynamics often conflict. Regulatory clarity strengthens long-term structure. Liquidity tightness creates short-term pressure. Geopolitical risk creates short-term pressure but builds long-term demand for alternatives. Markets oscillate between these time frames. Understanding which dominates at any moment helps you interpret price action without overreacting. Second, watch liquidity indicators more than headlines. Money market fund balances, Treasury auction results, Federal Reserve balance sheet changes. These metrics tell you whether liquidity is expanding or contracting. That's more predictive than news about regulations or conflicts because liquidity is the fuel that moves all assets. Third, distinguish between structural shifts and cyclical volatility. The Clarity Act is structural. It changes what's legal and who can participate. Treasury issuance is cyclical. It happens regularly. Geopolitical conflict can be either. If it resolves quickly, it's cyclical volatility. If it restructures global finance, it's structural. Fourth, avoid binary thinking. Markets don't go straight up or straight down. They react to forces, digest information, and reprice based on probabilities. When multiple forces pull in different directions, markets chop. That's not weakness. That's complexity being processed. Fifth, understand that most participants are reacting emotionally to each headline without considering how the forces interact. When you see panic over geopolitical developments, ask whether anything structural changed or whether it's just volatility. When you see euphoria over regulatory news, ask whether liquidity conditions support a sustained move or whether it's just a short-term sentiment shift. And finally, remember that systems take time to adjust. Even if the Clarity Act passes tomorrow, banks don't integrate stablecoins overnight. Infrastructure takes months to build. Compliance takes time to implement. The market often front-runs the actual adoption, rallies on the news, then consolidates during the execution phase. That's normal. It's not a failed prediction. It's how adoption actually unfolds. If this changed how you think about markets when multiple forces converge, subscribe. We're here to teach systems thinking, not headline reactions. We're here to explain how regulation, liquidity, and geopolitics interact, not to predict what happens next. Drop a comment if you're seeing connections between these forces that you hadn't considered before. Let's talk about how complexity works in real time. Because the goal isn't to eliminate uncertainty, it's to understand how systems respond to it. Markets are complex adaptive systems. They don't follow linear logic. They respond to the interaction of forces across different time frames. Learning to think in those terms makes you resilient to volatility instead of paralyzed by it. Regulation sets the structure. Liquidity determines the flow. Geopolitics shifts the priorities. All three are moving right now, and understanding how they intersect is worth more than any single prediction about what happens next. Because predictions fail, systems thinking endures. And right now, that's the skill that matters most.